Oil has no flag, no anthem, no single ruler. Yet for more than a century, it has quietly decided which nations rise, which collapse, and which are allowed to dream of power. Every morning, billions of people wake up governed by prices they never voted on. Prices set by barrels buried deep beneath deserts, oceans, and contested borders. The paradox is unsettling. The world speaks endlessly about innovation and digital futures, yet global power still bends to a substance formed millions of years ago. When oil flows freely, economies appear stable. When it tightens, governments panic, currencies shake, and ordinary families feel it first. At the pump, at the grocery store, and the cost of simply staying alive. Investors watch charts flicker red. Analysts lower their voices. Diplomats begin flying quietly, urgently. Somewhere, a decision is made, and the consequences ripple outward, unseen but unmistakable. This is not just a story about energy. It's a story about leverage, about how oil became a financial weapon, a geopolitical shield, and a silent vote that outweighs elections. It's about nations rich in resources yet trapped by them, and nations without oil that learn how to control it anyway. And it raises an uncomfortable question. In a world that claims to be free, who really decides the rules? If stories like this fascinate you, subscribe and join us as we uncover the hidden mechanics of global finance. And tell us, what country are you watching from? Long before oil became a headline or a weapon, it was simply a discovery, thick, black, and inconveniently messy. In the late 19th century, drillers weren't thinking about global dominance. They were chasing light for lamps, fuel for machines, a faster way to move goods across expanding nations. But buried beneath that practicality was something far more dangerous: leverage. As industrial economies accelerated, oil quietly replaced coal as the lifeblood of progress. Engines ran longer. Ships traveled farther. Factories multiplied. And for the first time, economic growth became tied to a resource that was unevenly distributed across the planet. Some countries had it in abundance. Others had none at all. The imbalance was subtle at first, easy to ignore in a world still obsessed with railroads and steel. Early financial signals appeared in unexpected places. Shipping insurance premiums shifted. Military planners began revising maps. Investors noticed that companies with access to oil-rich land behaved differently, more confident, more aggressive, less patient. Journalists at the time described a strange calm in boardrooms where oil had been secured and a quiet anxiety where it hadn't. Governments responded instinctively, not strategically. They subsidized drilling. They protected domestic producers. They dismissed warnings that dependence could become a liability. To ordinary citizens, oil felt like progress made visible. Brighter cities, faster travel, cheaper goods. Few questioned the cost of tying national survival to something that could be controlled, restricted, or withheld. By the early 20th century, the shift was irreversible. Economists began to realize that oil wasn't just an input, it was a multiplier. Control energy and you influence production. Influence production and you influence prices, wages, and stability itself. A new hierarchy was forming, not based on population or ideology, but on access. And just as the world began to understand oil's power, a more unsettling truth emerged. Those who owned the ground didn't always control the game played above it. The illusion shattered quietly. As oil-rich regions drew foreign interest, contracts grew more complex, written in boardrooms thousands of miles away from the land itself. Governments that sat atop vast reserves discovered they were junior partners in their own destiny, trading long-term control for short-term revenue and political recognition. Western corporations arrived with capital engineers and legal language dense enough to disguise imbalance as partnership. To the public, it looked like development. To financiers, it looked like ownership without borders. Markets reacted before politicians did. Capital flowed not toward nations, but toward firms that controlled extraction, shipping, and refinement. Stock prices rose on discoveries that had nothing to do with national productivity and everything to do with access. Analysts began speaking about energy security in hushed tones, as if naming it too loudly might expose the fragility beneath modern growth. Meanwhile, ordinary citizens in oil-producing countries noticed a strange contradiction. Wealth flowing in, yet daily life remaining stubbornly unchanged. By the time global powers fully understood what was happening, the trap had already closed. Oil was no longer just beneath the ground. It was embedded in trade routes, defense strategies, and currency stability itself. Nations without oil learned they could still control it through finance, shipping lanes, and alliances. Nations with oil learned that abundance did not equal autonomy. And as this realization spread through ministries and markets alike, one question began circulating quietly among economists and diplomats. What happens when the flow is interrupted? The interruption didn't arrive with an explosion or a declaration. It came as a number. A sudden shift on commodity screens. A price climbing faster than models predicted. At first, traders treated it as noise, a temporary imbalance, a shipping delay, a seasonal fluctuation. But within days, the signals multiplied. Futures contracts widened. Volatility crept into currencies tied to energy imports. Something systemic was moving beneath the surface. In financial centers, reactions unfolded in stages. Investors leaned closer to their screens, refreshing data feeds that refused to settle. Energy analysts rewrote forecasts they had published only weeks earlier. Central bankers asked questions that had uncomfortable answers. Oil was no longer behaving like a commodity. It was behaving like a lever, pulled somewhere far from the markets, now reacting to it. Journalists began using careful language, describing uncertainty instead of panic, even as liquidity quietly thinned. For ordinary people, the consequences arrived with cruel simplicity. Transportation costs rose first, then food prices, then electricity bills. Small businesses adjusted hours. Families postponed plans. In oil-importing nations, governments scrambled to reassure the public while negotiating behind closed doors. In oil-exporting states, officials faced a different tension. Sudden windfalls paired with growing geopolitical attention. The realization spread unevenly but unmistakably. Oil wasn't just responding to the world anymore. It was reshaping it in real time. As prices surged, the illusion of control evaporated. Governments that spent decades preaching market efficiency suddenly intervened, releasing strategic reserves, negotiating emergency supply deals, softening language that once sounded absolute. Diplomats boarded overnight flights. Phone lines between capitals stayed open long past dawn. In private briefings, officials admitted what markets already knew. Oil shocks don't stay in the energy sector. They bleed into inflation, debt, elections, and social stability. Foreign markets reacted with instinctive speed. Currencies of import-dependent nations weakened, sometimes within hours. Stock exchanges in Asia and Europe opened heavy, then slid further as the day progressed. In exporting countries, equities surged briefly before investors hesitated, sensing political risk behind the profits. Economists exchanged glances on live television, a mix of restraint and concern. Careful not to trigger fear, yet unable to deny the pattern forming beneath the data. Corporations felt the pressure unevenly but immediately. Airlines hedged aggressively. Manufacturers froze expansion plans. Logistics firms rerouted shipments at enormous cost. In quiet offices far from trading floors, executives stared at spreadsheets that no longer balanced. The energy trap had revealed itself in full view. Even those who never touched oil were bound to its movement. And as markets searched desperately for stability, a deeper question loomed. If oil could do this so quickly, who truly had the power to stop it? When the volatility finally slowed, it didn't feel like relief. It felt like exhaustion. Markets stabilized, but the damage had already settled into everyday life. Higher costs, tighter credit, and a lingering sense that something fundamental had shifted. Analysts began speaking less about recovery and more about exposure. The crisis wasn't that oil prices moved. It was how completely the world moved with them. In oil-producing countries, the contradiction sharpened. Revenues rose, yet public pressure intensified. Citizens questioned why national wealth translated into fragile public services and volatile currencies. In importing nations, resentment simmered quietly toward markets, toward governments, toward forces that felt both distant and unavoidable. Journalists framed the moment carefully, calling it a lesson in interdependence, even as families experienced it as vulnerability. What emerged from the data was an uncomfortable truth. Oil doesn't just shape economies, it shapes behavior. It encourages short-term thinking, political compromise, and financial structures built on assumed stability. The trap isn't dependency alone, it's normalization. The belief that this arrangement is inevitable. And as that belief settled in, the world stood at a crossroads it had reached many times before, unsure whether this moment would finally change anything. In the aftermath, policymakers spoke about transition, cleaner energy, diversified supply, resilience. Investors nodded cautiously, allocating capital to alternatives while still watching oil tickers every morning. The contradiction was impossible to ignore. Even as the world imagined a future beyond oil, it continued to measure stability through it. Markets still flinched at rumors. Governments still calculated risk in barrels per day. The old power hadn't vanished. It had simply learned new language. For ordinary citizens, the lesson was less abstract. Energy costs lingered in rent, food, transportation, and opportunity itself. Choices narrowed quietly. A job not taken. A business not started. A country whose growth slowed just enough to change a generation's trajectory. These weren't headlines. They were lived realities. The global energy trap revealed how decisions made far from public view echo longest among those with the least insulation from volatility. And that is the quiet truth oil leave behind. Power in the modern world rarely announces itself. It hums beneath systems, disguised as normalcy, enforced through dependence rather than decree. Until alternatives are not just invented but trusted, oil remains the invisible referee of global ambition, not because the world wants it to rule, but because so far it still does. In the end, the story of oil is a story of influence we rarely see, but always feel. It shapes nations, markets, and lives with quiet persistence, reminding us that wealth and power are rarely earned in full view. The barrels beneath the ground are more than fuel. They are measure of control, a mirror of ambition, and a silent judge of human choices. And as the world searches for alternatives, one question lingers. Can we ever free ourselves from a trap that has defined the rules for over a century?